So we wanted to also take a look today at the economic impact of everything that's been happening with the slowdown and the projections of the impact on GDP. So we've put together some charts we wanted to share with the viewers. First thing is really the employment levels and how they may be impacted by the virus and the slowdown in the economy. So we have a chart here. Why don't you walk us through what we're looking at?
Yeah, this one could be unique in that it's a service-based recession, and the largest casualty will be the amount of jobs lost, hopefully temporarily. But you start to look at employment by sector and you break it out into what are the sectors that are most at risk, the payrolls that are most at risk. Leisure and hospitality, retail, trade, manufacturing, in our view. So those sectors represent 30% of all non-farm payrolls in the U.S. So that's a huge chunk of jobs that could potentially be lost, hopefully temporarily. So you start to look at expectations for next week. Weekly jobless claims, the median estimate is coming in over 2 million. Right. So that's going to be a new record. Mm-hmm. Then you start to look at, all right, if that many jobs are lost, what's the impact on GDP? Right. So, I mean, it's not good news, but those three sectors of non-farm payrolls represent about 25% of real GDP. So potentially the economic impact will be less than the joblessness impact.
Right. And we're not saying that the other sectors won't be impacted.
Right.
These will just probably be the highest impact.
Exactly right. Okay. Yeah. And additionally, you start to break this down and you look at those three areas that are most likely going to be most significantly impacted, the at-risk sectors, and you start to think, well, what types of wages will be lost here?
So what are we looking at
and
here?
How many? So if you focus on the vertical axis, that's the number of people employed in each of these sectors. So the higher you are, the more people are in the sector. So leisure and hospitality and retail and trade, that's a lot of jobs, a good chunk of jobs. And then on the horizontal axis, as you move to the right, you get higher weekly earnings. So you start to think of leisure and hospitality, a lot of folks in that industry, generally lower wage jobs. And that's why fiscal stimulus, and we're talking about cutting checks, a $1,000 check, it may not seem like a lot, but to some of these people in the leisure and hospitality industry, it can definitely help. Right. It can be a big benefit. So that's how we think this one is more likely to play out.
Okay. And let's talk about the larger projected impact to GDP. So we've seen all sorts of estimates from down 2-3% to down 14-16% for Q2.
Right.
I think there's consensus and good data that would say for the first quarter we're flat, or just maybe slightly positive or slightly negative. But Q2 looks like it's going to be a big down quarter.
Yeah. And so how we come up with some reasonable assumptions, we estimate Q2 GDP is probably going to be down somewhere around 6% annualized. And so how you arrive at that, you take Q1 GDP and you think, what's the level of personal consumption expenditures that are at risk? So you think clothing and footwear, gasoline, transportation services, recreation services, food services, et cetera. That's $2.9 trillion of GDP that is at risk. If you basically assume that half of that is lost, it's demand destruction. Now the government has a big gap to fill.
Right.
Because all the fiscal stimulus, all the government expenditures are going to try to make up some of that. So demand is destructed. We get a total fiscal stimulus of over $1 trillion. And there it is. You're down 5.8% as a seasonally adjusted annualized rate.
Right.
And estimates are very wide ranging. So we'll see how this ultimately plays out. But the other thing is trying to think, how will the market react to being down 6% quarter over quarter? You would think, well, if we're only down 2, the market should view that as good news. That's possible. But what we're trying to do here, the health response currently, is to shut down the economy.
Yeah.
So there's certainly a potential that if Q2 GDP is down 10-15%, well, we probably did a really good job at shutting down the economy and doing social distancing. Probably a
Perhaps.
really good job, potentially. And so you
Perhaps.
could see that. You could actually see the market react positively if Q2 GDP is worse. Because they think, hey, if we really took this seriously and shut down the economy, maybe we have flattened the curve. Maybe we're going to get over this virus quicker.
Right, and I think it becomes less about the magnitude of the GDP number. If we've made substantial progress against the virus, and if we have vaccines in the pipeline, or we have other good news, that's going to support the market, because everyone's sort of priced in a disaster Q2 already.
Yeah, that's
Right?
exactly right. This fiscal stimulus can be that bridge. The shorter the bridge, the easier it is to build.
Sure is.
Okay, so we can get over this quickly. The fiscal stimulus can really be impactful, but sending $1,000 checks every 2 weeks for 6-9 months, that's going to be tough.
That's going to be rough.
Yeah.
All right, and finally, let's, encouraging or not, I think this is an important thing to look at, because not a lot of people are aware of the magnitude of room that the Fed has to really support the economy.
Yeah.
And they've announced some significant measures today to support the economy. But let's take a look at what we have here and put this into context.
Yeah, so the dark blue line, that's the size of the Fed's balance sheet as a percentage of U.S. GDP, 19%. So that's huge. That's about $4 trillion currently.
Right.
And you think, oh, the Fed's out of bullets. There's not much more they can do. Well, they can do the same thing, but a lot more of it.
Right.
The ECB, for example, the lighter blue line, their balance sheet is running at almost 40% of GDP. So if the Fed were to get to that point, you're talking about $4.3 trillion of additional monetary stimulus that's going to go somewhere. It's going to buy corporate bonds. It's going to buy municipal bonds. It's not, I mean, it's certainly not a vaccine.
Nope.
But it can keep markets functioning properly as we get over this situation.
It indirectly supports stocks because it crowds out other buyers and forces people into stocks as well.
Yep. And then there's the Japan situation. We're not calling for that, but it just can go, goes to show, I mean, central banks have literally unlimited firepower.
But it shows the potential, right? And,
Right.
and it helps us see from a standpoint of what the government can do and the reactions they've taken so far. It's somewhat comforting that they will make this right. We're committed to keeping you up to date on these items as they play out. We have been working hard on our research. I want to thank the research team. Our team's been working overtime to get this stuff done, and they've really are owed a debt of gratitude here for all the hard work they've put in. So thanks, guys and ladies. And we will be back next week with more updates. And in the meantime, if you need anything, just feel free to give us a call.
Thank you.
Have a great weekend.